Hello everyone, Clifford Bennett, Chief Economist, ACY Securities. It's a wrap for the week almost, but we do have New York trading ahead of us. Now, not many people saw the crash of Thursday coming, but we did. We said Monday would be a strong day, and the market would rally, but by the end of the week, we'd be back plummeting lows. And that's certainly what we're doing as we head into Friday's Wall Street action. Of course, the data yesterday in New York, I'm able to say, just simply continues to confirm the scenario I've been mapping out for you all along, which is that the US economy is crumbling. Indeed it is, without any prospect of hope or support from China or the EU, who have their own problems. So unlike in the GFC, where China remains strong and this helped other economies to stabilize and recover, this time we're looking at the simultaneous slowdown in all three major economic regions. Now, in the United States yesterday, we saw durable goods orders absolutely collapse, and it was a big move for that data series. It doesn't usually behave quite like this, falling a sharp 5.2% durable goods orders. 5.2, not 0.5, 5.2%. And this, of course, happened on the same day that US mortgage rates hit a 22-year high, 7.23%. And it's a sharp acceleration that is going on in the mortgage market to the upside. As I've said all along, the Fed may stop raising rates, but that doesn't mean interest rates aren't going to continue to climb for consumers and businesses across the United States going forward. Now, this increase in mortgage rates and this general increase in commercial lending rates across the United States is not due to incredible demand, as it might have been historically. It's due to fear. Basically, lending institutions don't want to lend for even really previously valid, solid property proposals and whatever it is, or business proposals. So this means they can charge more to lend, but also on top of that, they have to price in the increased risk of what's going on in the United States economy on Main Street. Now, the banks and the ivory tower types in Wall Street may be able to ignore what's going on in Main Street America up to a point, but when it comes to lending to Main Street America, then suddenly the penny drops. So the big banks do not want to lend very much at all at the moment. So they are charging more, and they're seeing the real risk, and they're needing to increase their lending margins to accommodate that increased risk that is now there, clear to see for everyone in the United States. I mean, it's a little bit like one of those old science fiction movies, you know, the case of San Francisco, and to some degree it's growing in LA as well and other cities. But in San Francisco, it's a very mature cycle of a hollowing out of city where gangs and crime have taken pretty much control of the center city region, and the police are just unable to cope. In fact, police force has stopped responding to a large number of assaults and calls. They're just overwhelmed, completely overrun. It is like a science fiction movie, and it's a tragedy for the people involved. It's a tragedy for the people involved in the crime. It's a tragedy for the homeless people. It's a tragedy for the people with those horrible, terrible fentanyl and other drug problems. As I've said before, the number one cause of death in the United States now for the 18 to 45 year age bracket, both male and female, is not heart disease. It's not cancer, it's drug overdose. Now, if that doesn't tell you there's something wrong with the US society at the moment, I don't know what will. And you have cities hollowing out. You have police forces losing control of their city. It's like in a science fiction movie, yet sadly, that is the reality in the United States at the moment. And this is something that will continue to impact a wide range of major cities in the United States. Their property values will eventually give way to these pressures, as already the banks are beginning to stop lending on even what used to be $50 million businesses. As I said the other day in one of the videos, There's a chap who needed to borrow a fresh $9 million that was rolling over against his $50 million property, and he couldn't even get the $9 million. So that's how hard it is to borrow money in the United States at the moment for even big property. And it's going to get very hard for small property, which is what we're seeing in the mortgage rate hitting a 22-year high. So what I keep saying about the US economy, and it's incredibly distressing, is that it is in disarray. It is slowing sharply. It can fall off a cliff. Yet the administration in Washington is still saying the economy is strong and doing nothing about developing policies to save this crumbling economy. At the same time, the Federal Reserve remains blinkered focused on inflation, and inflation does look like it's rekindling yet again, so they will not be cutting rates. They will be maintaining a tightening bias. And the outlook, therefore, is for stable to higher interest rates, with the commercial sector taking rates even higher in what is a manufacturing recession, falling property prices, car loan delinquencies, GFC levels. The list goes on and on for the United States. How anyone says it's a strong economy is beyond me, unless they have cognitive problems, of course. So the outlook then is nothing's going to save this US economic slowdown, either domestically in terms of policy from either the Fed or the administration, or externally from the rest of the world economy being strong and therefore helping the United States buffet its own domestic worries. None of this is there to rescue this economic slowdown, which is why I'm probably one of the most bearish people you're going to be hearing from or reading, because I'm prepared to call it as it is. You know, what I do, I call look out the window economics at what's going on in the world and understanding the new forces that are occurring. You can't find any of this stuff in any economic textbook. You have to look out the window and you have to apply common sense to this very fast changing, evolving situation. And that's what I'm trying to do for you. And that's why I find myself having to warn. Things are going to get much worse in the United States. China does not look like it has a soft landing in sight yet. And the EU is beginning yet another fresh tumble to the downside economically. We already have a global manufacturing recession, which all leads us to which way do we think the stock market goes from here, given that currently PE ratios in the United States are above average? What are they doing above average? They should be near the bottom of the historic range. That's why there's significant downside risk to equity markets in the United States and elsewhere, and of course to property valuations. The cheery side of all of this, it's better to know in advance than to be caught out not expecting it. And if you are understanding that these are real risks, start to adjust your investment portfolio appropriately, and you have all the tools to do that. Thank goodness we live in this modern economic system and financial market system where we can manage these risks very successfully. I hope you have a good day and a great weekend ahead. Clifford Bennett.